Alright, you finally done it. You've got your 401k open and now it's time to invest. My name is James Travis, and in this video, I'm going to walk you through 2 ways to invest in your 401k or Roth IRA. You're going to learn what I've chosen to do with my portfolio so you can learn how to invest your money wisely yourself. I've taught this to my best friend who has now recently opened up his 401k. So he has the ability, by using the rule of 72, to double his money by investing in it. So, like I said earlier, you finally opened up your 401k account, but that's not the end. If you don't invest your money, you have no chance of making it grow in that account. In this portion of the video, I'm going to tell you everything that you need to know about asset classes. We'll be covering what are asset classes, how you should allocate your assets, and why portfolio diversification is important. This tower of assets represents the choices for your different investments. At the bottom is your most basic level of investments, such as stocks, bonds, and cash. In the middle we have index funds and mutual funds, and at the top we have life cycle funds. As you can tell on the left side of it, the stocks, bonds, and cash are less easier to use, while the life cycle funds are more easier to use, but you receive more control over your money depending on where you want to invest it. In this video, we're only going to cover stocks, bonds, and cash, but over the course of this lesson, we're going to dive into each asset classes and find out what their advantages are. At the bottom of the chart, we have stocks, which are, as you probably already know, shares of a company. They have great returns if you pick a winning stock, but you could lose a lot of money if you pick a losing one. In general, stocks as a whole provide excellent returns, but individual stocks aren't as clear. If you invest all your money into one stock, sometimes, it could go up or it could go down. So you might make a lot of money or you could end up losing a lot of money. I've had both of those happen from personal experience. Stocks are a good way to earn a lot of money over the long term. When it comes to your 401k, you don't want to invest in individual stocks. Instead, we're going to invest our 401k into funds, which is a collection of stocks, which lets you reduce risk and create a well-balanced portfolio. Next, we're going to talk about bonds. Bonds are basically like IOUs, where if a company or a government borrows money from you with the promise to pay it back plus interest. Bonds are generally long-term investments of 10 plus years. The best part is you'll know exactly how much you'll get once it matures. They're especially stable, especially the government bonds, so you really don't have too much risk involved with them. The only way that you lose money on a government bond is if the government decided not to pay you back, and it never does that. If the government runs low on money, the Fed just prints more of it. You'll always get the money that they promised you back. The downside of bonds are your money would be unusable for the period of the loan. Technically, you can withdraw early, but you'll end up losing money doing that, so it's not a very good idea. The other downside to bonds are they generally have a low rate of return. We'll cover this later, but that's why when you're young, you don't really want to invest in bonds because we have time on our side to make more money in stocks. The last thing that we're going to talk about is cash, which is uninvested money. It's good for emergencies, but not really great for investing. In fact, you want to have as little or no cash in your portfolio if that's possible, because you already have cash in the bank, in your wallet, and maybe under your mattress at home. Each asset class has smaller subcategories, and we want to invest in them all. This is called diversifying. Diversifying means going deep into a category by buying, for example, different types of stocks, such as small cap and international stocks. You'll see on your 401k, it gives you the option to invest in large cap, mid cap, small cap, international investment, and other type of stocks. We want a good mix of each one of these stocks, so in case something bad happens, we don't have all our money in one basket. The reason why diversification is important is because the stocks in each subcategory don't perform consistently. Their performance may vary from year to year. So balancing your portfolio, make sure that you don't have all your eggs in one basket. So you'll have different categories of stock, meaning one stock fund doesn't drag you down if it performs poorly. For example, if the only stocks in your portfolio were international stocks and they did badly over the course of 5 years, you wouldn't make much money. That's why it's important to have a good balance of different types of large cap, small cap, international stocks. So if one does badly, the other ones have you covered. We're going to go into the specifics of what percentage of your portfolio should be stocks and bonds and everything else in later videos. But if you're young, which is basically under the age of 35, you can afford to have 100% of your portfolio in stock funds. The reason why young people can afford to have 100% of our portfolio in stock funds, the reason why it's okay for young people to get away with having 100% of their portfolio in stocks, because even if the entire market drops temporarily, we have time to recover. When we're older, it's better to have less aggressive investments because time isn't on our side anymore. Honestly, when you're young and just starting out, the biggest danger isn't having a portfolio that's too risky, it's being overwhelmed and not investing at all. Not playing is the only way to lose when it comes to investing. That's why I'm here to teach you the basics and not get overwhelmed by all the variables there are in investing. Next, we're going to talk about asset allocation. If you own shares in different companies, that means you're diversified, but only within stocks. Asset allocation is about allocating your assets between different asset classes because investing in one category long term is dangerous. As we already covered, high risk also means that you have a higher potential for a reward. Bonds decrease the risk to your portfolio when you don't have time. That's why it's important to have them to help balance your portfolio when you get older. Timing matters. If you're in your early 20s and have dozens of years to grow your money, a portfolio made up of 100% stocks makes sense. But if you're older and retirement is coming up within a few years, you don't want to have high risk. That way, if the market tanks, you still have control over your asset allocation. Lastly, bonds generally perform better when stocks fall. If something bad happens in the market, you still have a buffer where you've locked in some profit. Owning other asset classes is meant to offset bad times. As we can see from our types of assets, we still have mutual funds, index funds, and life cycle funds to cover. So we'll start with mutual funds. Mutual funds are a collection of stocks that are grouped by similarities. Tech and retail stocks are a good example of that. They can also be grouped by location, such as Asian stocks or small or large cap companies. Mutual funds allow you to diversify your portfolio without much effort because they hold a collection of stocks. If one stock tanks, you won't lose as much money compared to if you had invested in only one stock. Your 401k contains some mutual funds, and I'll show you how to pick the best ones for you soon. That being said, I would avoid investing in mutual funds outside of your 401k. It's true, they offer you an opportunity to easily diversify your portfolio and in general are profitable, but they cost a lot in yearly fees to maintain because they require a quote-unquote expert to guide you in the right direction. Besides, I'm going to teach you how to be your own expert and manage your own money without paying all those fees. Next, we're going to cover index funds. Investing in an index fund means that you're buying the entire market. For example, if you bought an index fund for the S&P 500, you bought an index fund which is a collection of the largest 500 companies in America, so your money grows with the growth of the full index. This works because the average investor will work harder and still won't beat the market. Mirroring the market's steady 7% growth a year on average will keep your money growing ahead of inflation. The only downside to index funds is that you have to adjust your investments within the fund to make sure you're diversified. Believe it or not, there are even easier ways for you to invest. Life cycle funds pretty much do all the investing for you based on your age. When you're young, the investments are aggressive because, like I said in the last video, you have time for things to get better if the stock market declines. As you're older, you'll want to hold on to some of the gains that you've made over the years and your investments become more conservative. These funds are stupid proof because you have no control. They're automatically diversified because they hold a mix of stocks, bonds, and funds. You don't have to do anything to rebalance it or invest it correctly. You just need to add money and watch it grow. Lastly, life cycle funds require minimal investments between $1,000 to $5,000 to get started. I've seen some as high as $2 million, so it's best to save enough to invest before you open that account. In the next video, I'm going to teach you exactly how to pick your 401k investment so you can get the maximum return for your money. In this part of the video, I'm going to be covering what a 401k match is, should you be investing in a Roth IRA, and how to invest in your 401k, step by step. Alright, I know I've covered this in previous videos, but you need to take advantage of any match your employer offers. It's literally free money. Ask your employer what percentage they match and contribute that amount to your 401k. Because like I said, they're going to match it, so they're going to double that amount of money that you contribute. Now, after you met the match for your 401k, the remaining percentage should be invested into a Roth IRA. Like I also explained in the previous video, a Roth IRA allows you to contribute after-tax income that won't be taxed when you withdraw it at retirement. Next, we're going to cover exactly how to invest your 401k. Your portfolio is probably going to need to be rebalanced every 6 months or even sooner, so set a reminder for yourself to do so. When you invest manually, you'll have to do all the rebalancing yourself. Part of having proper asset allocation is that you don't invest evenly. We'll have more on that on the next slide. Whatever you do under any circumstances, do not sell your investments when the market dips. You're basically throwing away money if you do that. The most important thing is that you diversify your portfolio so you can minimize your risk that way. On this slide, we're going to be talking about asset allocation. Asset allocation means that no single investment represents a majority of the portfolio. Management fees can make or break your portfolio. You should be paying less than a 75th of 1% for management fees for your portfolio. Otherwise, you risk having all your gains eaten by management fees. Lastly, your portfolio does not have to be an exact reflection of the Swenson model that I'm going to tell you about in a second. You should start off with 3 funds and then add more funds as your portfolio grows. So like we talked about in different videos, it's important to diversify within stocks, but it's even more important to allocate across different asset classes. So like I said, it's even more important to allocate across different asset classes because investing in one category is dangerous over the long term. Because if the market dips in one particular category like tech and all your stocks are in tech, then your portfolio overall suffers. Now, if you have a balanced portfolio where, only some of your investments are in tech, then, you hedge against losses because maybe the entire market doesn't dip as much. So diversification means that we go deep into a category. For example, stocks have large cap, mid cap, and small cap, and even international stocks. Your 401k more than likely won't have individual stocks. So you'll have a category of large cap, mid cap, small cap, and even international stocks. And then your assets want to be across different categories such as stocks, bonds, and cash. And of course, the most important thing to allocate your assets are determining what returns each category offers. So based on the different types of investments you make, you can expect different returns. Higher risk normally means higher reward. But like I said earlier, potentially higher risk does mean that you could lose some. That's why it's very important to diversify. That's why you should own a variety of different assets in your portfolio. If you put all your money into, let's say for example, large cap stocks and they don't perform well, it's not a good thing. But let's say if you own some small caps and large cap and a variety of different bonds, you'd be more insured against one investment dragging you down. For those of you who don't know David Swenson, he manages Yale's portfolio, and he's been responsible for 16% growth year over year, which normally you can expect an 8% return on your investments. He's been doubling that year over year since I believe 1992. So this is how his asset classes are broken down. 30% are in domestic equities, 20% in real estate, 15% in government bonds, another 15% are in developed world international equities, the last 15% are in treasury inflation protected securities, and the final 5% are in emerging market equities, which of course equals 100%. What's less important for you is the exact numbers for allocating these assets. What's most important is that no single choice represents an overwhelming part of the portfolio, because as we know from experience, any sector can drop at any time. That's why if a bubble were to burst, like for example what happened in 2001, we wouldn't wipe out our entire portfolio if something bad were to happen. And of course, lower risk does equal lower reward, but the coolest thing about asset allocation is that you can actually reduce your risk while maintaining a solid return. That's why this Swenson model is a great model to base your portfolio on. Finally, before we dive into a hands-on look of a portfolio, past performance doesn't guarantee future success, but it is a strong indicator. Second, never invest into a money market account because that's basically just your money sitting in cash. It won't grow at all. Lastly, this one involves a little bit of math. You can achieve your target asset allocation by multiplying your total investment money times the percentage you're allocating for a particular investment. Now that we have an understanding about how investing works, let's dive into a portfolio and let's see how it's done. As you can see from my own personal 401k, everything's diversified. Not too much of my portfolio is overwhelmed by one investment. So next we're going to dive into exactly how we can determine what would be a good investment for our 401k or Roth IRA. The only real difference will be our options in these accounts. So I know one of your biggest questions is, how do I know if the asset class I'm going to invest in is going to be a worthwhile investment? Like the saying goes, past performance isn't a guarantee of future success, but it is a really good indicator. We're going to be basing our decisions on the past performance of these investments. We're going to start with a mid-cap investment. What we really want to keep our eyes on is how well it's done so far this year and in past years. What's really important is the investment has to have a long history of growing over time. So because this is a retirement account, we really don't care what it does day to day or even week to week. As long as over time your investment grows, that's what's most important. So again, because we're doing this ourselves, I would invest the largest portfolio percent in the most aggressive asset that has proven to have long-term success that we can find. Next, we're going to go over to another asset, which provides us different options. It's had positive long-term growth over the last 10 years, but here's one thing that I really want to point out. Check out how much the fees are, because the fees that you pay can make or break your portfolio. For this investment, the average expense ratio is 0.02%, which means you pay about 20 cents on every $1,000. Now, if you pay attention to the chart, you'll notice that this investment grows at about the same rate as the S&P 500, which means technically it's a pretty safe bet. In this investment, we have low fees and steady growth. There's not much more that you can ask for. Lastly, we're going to talk about the investments that you want to avoid. These are the underperformers. Check out this investment. Over the last 10 years, it's lagged behind the S&P 500 and every other benchmark provided. Even though the expense ratio is really good, you just won't make as much money as you would by putting your money elsewhere. So to keep things simple for you, if you want to invest in an asset, make sure that you've got, a steady history of growth. That's where you know where to invest. Now, if you don't have that kind of growth, then I recommend not taking the chance on it, because this is going to be a long-term investment. This is something that you're going to buy and hold for a very long time. This is why I advise going away from stocks, because it's a lot less risk in the portfolio when you buy a blend of different assets. So just to reiterate, just to make sure that everyone gets it, we want to check the past history of any investment that we're going to make and make sure that it has positive growth and a low expense ratio. We want to stay away from investments who have not performed well in the past, because we're not going to play a guessing game with our retirement. Like I said earlier, we're going to mitigate our risk by investing unevenly also. It doesn't have to be 100% David Swensen, but I highly recommend that it be Swensen-ish. The important thing is to mitigate our risk by diversifying. Thanks so much for watching. If you learned something new, please hit the like button. As promised, in the description below, you'll find a link for how to open and invest in your own 401k. Also, you'll learn other investment opportunities that you can take advantage of. For more videos on investing and building wealth, please hit the subscribe button.